Hey guys, today we're going to take a break from the specific types of transactions and instead focus on the end result of what those transactions are becoming with our accounting. An owner or manager or other form of stakeholder needs to be able to tell at a glance how the company is doing. They need to see how their sales compare to their costs and what does the company own or what does the company owe to other people. The most commonly used reports are called financial statements. There are three types of statements called the income statement, the balance sheet, and the statement of owner's equity. The income statement shows the results of business operations for a specific period of time. The balance sheet is a snapshot of a specific moment in time that shows the exact assets owned by the company and the liabilities that the company owes other people. And of course, the remaining equity that belongs to the owner. The statement of owner's equity reports the changes that occurred in the owner's financial interest during the reporting period. Once we're done with all these three statements, you'll see how the numbers tie in between them, making them a single important source for use by the manager, owner, or other creditors. Today we'll look over the income statement. This statement shows the operations of the business for a specific period of time. Commonly, these time periods are monthly, quarterly, and annually. Sometimes these statements are called profit and loss for a business, but for my purpose, in all these videos, I'll refer to them as the income statement. The income statement's purpose is to show the difference between income from goods sold and services performed and the cost to operate the business. This results in a net income, which is when the revenue is greater than the expenses at the end of the time period, the net loss, when the expenses are greater than the revenue, or the break-even point, when revenues and expenses are equal. Now, let's refer to the pre-prepared income statement used in the transactions that occurred at Jello's coffee shop. We'll do a monthly income statement covering all of his operations during that time. The first thing to notice about income statements is that there's a three-line header at all times. The first is the who, Jello's coffee shop, of course. The second is the what. That is, it's the income statement. The third line indicates the time period covered by the statements. In this case, it says the month ended January 31st, 2014, indicating this is only for the month of January 2014. Another formatting item about income statements, there are double and single underlines, as you see below. The single line indicates that all the items above it need to be added or subtracted depending on the values. The double lines indicate is the final amount for the statement. In addition, revenues and expenses are generally listed in the same order that they appear in your chart of accounts. So if we go back to the original one, you'll see we had rent, wages, utilities. So on the income statement, we'll have rent, wages, utilities. We only had one set of revenue, so it's only listed once. Another thing that is important is consistency. If they're listed in this order in this monthly statement, they need to be listed in this order in future monthly statements so a comparison can be done by the owner or the manager. So after we've looked at the three headers, we look at the next line. We have the first category. The category is revenue. We've titled the revenue Sales and Fundraisers, and we've placed the total amount. So if you go back to the transactions, you'll see the total revenue has been $45,000. Now, the one thing I probably should have done, and I didn't do in the prior accounting, is I probably should have broke the sales up and the fundraisers up so you'd have two sections and they'd be listed under each other. So for now, we'll stick it as one item. The second area is expenses. You have the rent, wages, and utilities, just like I showed you before, and they're listed as well. And in order to get the total expenses, you'll notice there's an underline on the expenses, and the total is down here. One other formatting thing that I did not mention, all these sub-items under a category should be indented in. So this indicates that they're all under expenses, where the sales and fundraisers under revenue. You will notice we did not list Jello's equity withdrawal of $10,000 from the previous video. This is not part of normal business operations, so it would not be listed here. That will be in the statement of owner's equity. You'll notice under this revenue amount, you'll see one single line. This indicates it should be subtracted from the $45,000. This leaves us with a total of $39,000 profit that Jello made, net income. Excellent choice. And it's double underlined, indicating this is the final amount. So we'll outline that is the final amount. That is his profit for the month. He might have chose very well opening this coffee shop if nothing else bad happens. Well, guys, that's just a quick overview of the income statement. Next time, we'll cover both the balance sheet and the statement of owner's equity. I wanted to kind of break these up so I could focus on each one and you didn't get overwhelmed by too many things. Well, until next time, take care.